Good morning, ladies and gentlemen. I'm Steve Harney, the founder of Keeping Current Matters. Welcome to this Monday's edition of the Deep Dive, where we're going to cover mortgage rates in a very thorough way. Before we get started, I want to let you know that a very important opportunity awaits you this Wednesday, because we're going to be doing an actual webinar just on what's going to take place in 2024 in the market. We're going to cover mortgage rates. We're going to cover prices. We're going to cover transactions. We're going to cover everything you need to know in order to make sure that 2024 is exactly what you want. Again, that's this Wednesday, 2:00 Eastern time. Make sure you plan a little time to get on that webinar. It might be the most important thing you see this year. Now, going on with today's deep dive, are mortgage rates going up or down? Well, it's all according to when your start date is. If you're talking about 3 years ago, they're way up. If you're talking about a year ago, they're kind of a break even to where they were a year ago. If you're talking about this past October, just a couple of months ago, we're down over a full percentage point. So there is some dependence on what the horizon, going back, what the horizon is that you're looking at. All right, there could be an argument made that they're up or they're down. And that's the reason we titled it that way, because we want you to be able to explain to your clients exactly what's happening with mortgage rates, and more importantly, what it means to them. Now, I came across this quote that made me think about what you're trying to accomplish. If enough people have the same gut feeling about you, then you have a brand. Let's go over that again. If your customers and clients all have the same gut feeling about you, then you have created a brand. And the only thing that I'll ask you is, what do you think that gut feeling of your clients and your customers are regarding you? How do they see you? Do they see you as a trusted advisor? Do they see you just as a salesman trying to make a commission? What is your brand, not to you, not what you're trying to communicate, but what are they receiving? Because at KCM, we believe very strongly, and I know not everyone on this call is a KCM member, but at KCM, we believe very strongly, most agents know what's happening. Good agents understand what's happening, and great agents can explain what's happening. Going into 2024, I'll let you know, I don't know that most agents are going to make it. Well, I guess 50% would be most. That's probably the case. But some agents are still going to struggle through 2024. Good agents will do okay, right, because they understand what's happening. The great agents, the ones that are going to really knock the ball out of the park over the next 12 months, they're going to be able to explain what's happening. And that's what the deep dives are all about. Taking one topic and going deep on it so you can explain it to your customers and clients. Again, the purpose behind that is they have a gut feeling about you that they can come to for the truth. Not misinformation, not disinformation, not a sales pitch, but the truth is what's actually happening so they can make a good decision for themselves and or their families. So let's jump into mortgage rates right now. Now, as far as what you're going to say going out, I wanted to use this quote because I'm oftentimes reminded of it. Don't ever try and forecast interest rates, or more specifically, mortgage rates, because you'll always invariably be wrong. It's almost impossible to really forecast mortgage rates going out, because there's so many different things that are going to happen. Whether it's world conflict, whether it be economic conflict, whether it be what the Fed's decided to do this month versus last month, there are a lot of things that affect mortgage rates. But what we have to do is get through that and have the courage to at least have a feel for where they're going. Again, I don't know if you want to broadcast, this is what's happening, and stick a flag in your forecast, right? But you want to say, this is what we think is going to be taking place based on this. And that's what this deep dive is all about. Max Capri, in his book, Leadership is an Art, the first line of the book is, the first responsibility of a leader is to define reality. So let's look at the reality of what's taken place here since September of last year. What we saw is interest rates were climbing and people were starting to get hysterical. They went all the way up, and actually this is on the week-over-week basis from Freddie Mac. On the daily numbers, they actually jumped over 8% for 1 or 2 days. So we hit 8% there on the weekly basis. It went up to 7.79. But let's see what's taken place since then. They've decided to slide down. Now, again, let's go back to what we said up front. Are they going up or are they going down? Well, over the last couple of days, the last couple of days of last week, they started to tick up a little bit again. But now, looking at it right before this deep dive, the 10-year Treasury slipped back a little bit. So there's a chance mortgage rates are going to slip back again. But what we do know is they're still under 7%. They might touch 7 again, but they're still under 7%. And what is the general direction? They're very slowly ticking downward. Now, why that's important, ladies and gentlemen, is because we need inventory and we need buyers. There's plenty of buyers out there. But if a lot of inventory comes to market, we don't want it to be a housing crash where so much inventory comes to the market that we can't sell it. So what takes place is every time a seller decides to list a house, it gives us the inventory we need. And about 70% of the time, it also brings along with it a buyer. Now, if they're selling a second home, if somebody is selling a home that heaven forbid, a family member, their mom or dad passed away and they have to sell it, there's no buyer coming out of those houses. So that's why I say it's about 70%. But the vast majority of houses, when somebody sells it, they need to buy another house. The reason that inventory hasn't been coming to the market for the last 18 months is because the difference between interest rates now and what the person who owns a home has on their current mortgage has been pretty dramatic. So I wanted to break that down for you. And what we could see is there are still 78.7% of people that have a mortgage rate under 5%. So one of those people are going to decide that it makes sense, it's time to go. Before we get there, when it says 11.5% have over 6%, you might say, who are those people? We have to realize people bought over the last 2 years. So they'll all fall into that category. All right, let's get back to the people under 5%. When are they going to go ahead and make a move? Well, in some cases, it'll be a lifestyle situation. If a young couple has a condo, in the middle of the city, up above the pizzeria, because that was the cool thing to do. It had a great walkability score, and they moved in, newly married. It's a one-bedroom, small, but it's right in the middle of everything, and they're really enjoying it as two single people, or two married people, I should say, or single. But now you have a situation, they just found out that they're pregnant with twins. They're not going to worry about the mortgage rate. They have to go ahead and get a bigger place to live. So they're going to sell the condo that they're in now. So there are lifestyle changes, but there's a whole bunch of not need situations, but very strongly want situation. I want a nicer house. I want to be closer to my family. I need to get closer to my job because now they're bringing me back to work. There's a bunch of reasons why somebody really wants to sell, but the mortgage rate, that lock-in rate, has stopped them from doing that. As mortgage rates come down and as time passes, people will get more comfortable with, you know what? If interest rates are in the 6s, who knows, by the middle of the year, they might be in the 5s. More and more people are going to say, it's time for me to make the move. All right. But I want you to see exactly what takes place in there. Now, Lance Lambert, he's the founder of Resi Club. He's the former editor for the housing section of Fortune magazine. He just went out on his own in Resi Club, great company. We might be at a peak lock-in effect. Some move up or lifestyle sellers, lifestyles like that young couple, might be coming to terms with the fact that 3 and 4% mortgage rates aren't returning anytime soon. My estimation, probably never again in our lifetime. If the lock-in effect eases up further in 2024, it could help boost existing home sales from the very low levels experienced at the end of 2023. We sold, now I know that the December existing home sales report from NAR showed that on a seasonality, from a seasonal standpoint, that we were selling on a yearly average about 3.8 million houses. In actuality, last year, according to NAR, we sold about 4 million houses. We normally sell over 5 million houses. So that was a pretty dramatic drop down. What Lance is saying is that the lock-in effect, again, you stick a shock that kind of getting used to, well, if I want to make a move, I'm going to have to pay that price. Plus rates coming down where they're saying it's not as difficult as it was at 8%. I think there's going to be a lot of inventory coming to the market. I agree with him wholeheartedly. This is from Erica Plemons. She's the housing analyst at Bright MLS. Bright MLS is one of the largest MLSs in the country, covers the mid-Atlantic states. This is what she said. Homeowners who are selling aren't influenced by rates. with 90.5% of successful November sellers stating that they were going to sell regardless of what rates were. Let's go over that again. Now, she's giving us November numbers because the December numbers they don't have yet. All right. But in December, 90.5% of everyone who sold said the rate had nothing to do with it. Now, some of those people might have owned a house free and clear. Of course, the rate had nothing to do with it. Some of those people might have had enough equity that they could buy their move down house cash. So, of course, the rate didn't have anything to do with it. But I think that what we're seeing is more and more sellers are saying, let's forget about the rate and let's move forward. And buyers are in the same situation, just so we know. This is the top 3 reasons that buyers, now a buyer could be a seller who's going to sell and go ahead and purchase a home. The top 3 reasons buyers pause the decision to go ahead and buy their next house. 72.1% were about mortgage rates. 34.4% was about inventory. We couldn't find the house we wanted. And 17.4% was the affordability and home prices are really high. Well, affordability is still a challenge. It's getting a little bit, it's eking to be a little bit better each day as mortgage rates come down and prices stabilize instead of shooting up as they have over the last couple of years. All right. But the first 2, and they could pick more than one, that's why it doesn't add up to 100. The first 2 situations, mortgage rates and inventory, both of those are in the process of getting better. Inventory is up. I read something just this morning that year over year, inventory is up about 9%, new listings coming to the market. So more and more people are putting their house on the market right now because the mortgage rates are being affected. So the 2 major reasons that people were pausing buying a house, we're both seeing real good progress in both of those. But we're concentrating on mortgage rates today. I want you to understand that a mortgage rate is built by 2 different components. Not exactly this, but we could follow this over the years, and I'll show you that in a second. Number 1 is a 10-year treasury. So the 10-year treasury, as of last Friday, when I did this slide, the 10-year treasury stood at 4.13%. Then there's a thing called a spread. That's the amount of money put on top of the treasury that the mortgage companies are comfortable charging in order to go ahead and make a mortgage because they need to make money also. Okay? So that spread, and it's a little bit more detailed than that. All right? But I want you to understand there's basically 2 components that make up the mortgage rate. And as of last Friday, the mortgage rate was 6.92%. Add those 2 numbers up. Now, the interesting thing on the spread, which again, if we look back, is 2.79 right now. If we look back over the last 50 years, there is a very strong symbiotic relationship between the 30-year mortgage and the 10-year treasury yield. That's the spread. That the difference between that blue line and green line is what they call the spread. And we can see it almost runs exactly with one another. So over the 50 years, the average was 1.72%. That would be added to the treasury number to come up with the mortgage rate. And what we can see in 2023, all of a sudden that spread really jumped up. The spread is not always consistent. This is from Odetta Cushy, the deputy chief economist at First American. The spread is not always consistent. It actually widens during periods of economic or geopolitical uncertainty, as has been the case in today's market. And she's right. Now, I will tell you that we still have geopolitical uncertainty. There's no question about that. What's happening in the Middle East right now, what's happening in Ukraine right now. But what we are seeing is that the economic uncertainty is starting to wane. We're getting inflation under control. It seems that the Fed, we never know definitely what the Fed is going to do, but it seems like they've paused any rate hikes for several sessions now. And there's a lot of talk, we'll talk about in a second, that they might actually drop the rate. And if they go ahead and do that, all right, then what winds up taking place is the spread, that economic uncertainty, that spread will actually get smaller. It will constrict. So right now, the spread, as I mentioned, is a little bit out of whack, 2.79 versus the 50-year average of 1.72. So we have about a 1% difference between what it normally had been for 50 years and what it is today. If it was what it would normally be, if it was the 1.72, the 50-year average, instead of what it is today, look at the impact on the overall mortgage rate. We'd be in the 5s right now. So what's my feeling pretty strongly is, number one, the blue box, by the way, this morning it's come down just above 4 instead of 4.13, just above 4. Right before I came on, I looked at it. And so I think that that's going to hover around 4, maybe a little lower. And I think that the spread, as things calm down economically, I think that the spread will constrict. Do I think we're going to get back to 1.72? Nah, probably not. But even if we got back to 2, all right, and the Treasury, just constricted a little bit, we'd be just around somewhere between 5.75 and 6.25 mortgage rate. And I do think that that will spur a tremendous spring market. I think it's actually just a drop under 7 has spurred a lot of people come to the market. There's a lot of business out there. Don't miss the businesses out there right now. A primary driver of increase in the yield, that's that bottom number, remember the yield, the blue, over 2023 was inflation expectations. So the higher the current rate of inflation, and more importantly, the higher the expected future rates of inflation, the higher the yield in the 10-year as investors demand to be compensated for the inflation risk into the future. What is that saying? Well, Mark Fleming, again, First American, only the chief economist, what he's saying is that if we get inflation under control, there'll be a lot less volatility. If there's a lot less volatility, what I just said before, then probably even the 10-year Treasury, the blue part, will constrict some. So between the constriction on the blue part, as we get inflation under control, and a possible constriction on the orange piece, because the economy is like a little bit more balanced, we might be taking a look at low 6s. And not that I want you to repeat this saying you said it, but you could say I said it. I think that we might be in 5s in the middle of this year. All right, the high 5s, but when I consider 5s, I consider 5.995. We now forecast, and this is from Goldman Sachs, we now forecast 3 consecutive 25 basis points, about a quarter of a point cuts in March, May, and June to reset the policy rate from a level that Powell was recently taken to describing as well restrictive territory rather than just restrictive territory. What does that mean? Goldman Sachs is saying that the Fed, not only might they not raise the Fed rate over the first half of this year, they're suggesting that they're going to actually cut the Fed rate 3 times this year. Now, other people are saying other things. Other people are saying it's going to be later in the year. Some people are saying it's only going to be 1 cut. Some people are saying it's going to be up to 5 cuts. Some people are saying there's not going to be any cuts at all. But I want you to understand that in the overall situation, what the Fed is looking at inflation. And what they're seeing in inflation is, in fact, we are getting it back under control. So what does that mean? Doug Duncan, the Senior Vice President and Chief Economist at Fannie Mae. We anticipate that after the past several years of extreme volatility in interest rates, the 30-year fixed-rate mortgage will continue to moderate over the course of 2024, moving toward a rate below 6% by year end. Now, again, remember the first quote I gave you. Anyone that forecasts interest rates is probably going to be wrong. But I do want you to also understand that when I say I think that rates are going to be, in the high 5s by the middle to the end of this year, it's not like I'm the only person saying that. So what we're looking at right now is a tremendous opportunity for us. The market's going to rejuvenate. It already is rejuvenating. As a matter of fact, if we take a look at Fannie Mae's actual projections, how much they've changed, all right, because the economy is getting more and more under control. Just in December of 2023, that middle column is what they projected interest rates to be in each quarter of 2024. The last column of January 2023, December 2023, and the last column, January 2024, the most current rate forecast shows that by the middle of the year, we're going to be about 6, and we're going to be under 6 through the second half of the year. Now, I'm not saying that's going to happen. I'm not saying that's not going to happen. I am telling you, I think it's going to happen. So I think we're in for a phenomenal year this year. I think it's going to get back not to craziness like we've seen in 20 and 21 and first half of 2022, and that's good news. We want to return to some sort of normalcy. It also appears that mortgage rates are now falling. Here's from Dean Baker, Senior Economist, Center for Economic Research. They will almost certainly not fall to pandemic lows, 3 and 4%. Although we may soon see rates under 6%, which would be low by pre-Great Recession standards. Ladies and gentlemen, here's someone else saying it looks like we might be at 6% this year or below 6% this year. There is reason to believe, going back to Mark Fleming, there's reason to believe that the lock-in rate effect will ease modestly this year as mortgage rates come down. And when you could only imagine if they get below 6, again, someone suggesting they might, that even more people would be, again, in the money, and homeowners will become less anchored to that low rate that they got a few years ago. So I'm saying I think they're going to drop below 6. The Center for Economic Research, Dean Baker, the senior economist, says that. Fannie Mae saying that. And First American saying it's a possibility. So I don't think it's outlandish. Some people, when you say that, they're going to say, well, it's outlandish. Make sure you have these quotes. Remember what we said right from the beginning. What we're trying to accomplish here in a very, very big way is you're a great agent. Now, you might be a great agent already. That's cool. But the standard that you're going to have to hit this year to be a great agent is not to know what's happening, not to understand what's happening, but to be able to explain what's happening. And with that, you need evidence. You need data, especially in the world today, because there's all sorts of crazy, again, misinformation and disinformation out there about the housing market. You need strong data, quotes from reputable people, not someone doing a YouTube channel, out of their mother's basement. And that's what we try to give you in every deep dive. A real good understanding so you can explain it to your clients and give you all the tools you need, quotes, graphs, charts, data, to be seen as the professional, so you can explain it, so that they build trust in you. Homeowners who choose to sell are also often buyers too, that there should be an increase in sales activity. I've already mentioned that to you. That's important that we understand that about 70% of every house that comes on the market brings along with it a buyer. The housing market, like so many other markets, is almost impossible to time. The best time for prospective buyers is when they find a home they like, that meets their family's their current and foreseeable needs, and that they can afford. So I'm not suggesting anybody wait until the second half of the year until interest rates go down another half a point, another point. I'm not suggesting that. What I'm suggesting is they don't have to be afraid that the market's going to crash. They don't have to be afraid that interest rates are going to go to 10% and there's going to be no buyers out there. Everyone's going to panic and we're going to go back to 2008. Narratives that other people are trying to push right now. If they're looking to buy a house now, and as being said, they find a home they like, it meets their family's current and foreseeable needs, and they can afford it, buy it right now. As far as mortgage rates, which is the subject today, well, they can only do 3 things. They can remain the same, they can go up, or they can go down. So let's take a look at it. If they stay the same, if they buy now and they stay the same, well, they've saved the increase in price, which is probably going to happen moderately this year. And they didn't get hurt because the mortgage rate's still the same. If the mortgage rate goes down, well, depending. If it goes down far enough that it really makes a difference, they could refinance. And if mortgage rates go up, and again, I'm not suggesting they're going to go up. I think they're going the other direction. But if mortgage rates should go up and they bought a house today, a year from now, they'll thank you for helping them get that house today. If they see a house, if you have a buyer right now that finds a house they like, meets their needs, and they can afford it, help them get it. Don't let the fear of what crazy people are saying get in their way, because prices will this year. The only person that disagrees with this is Realtor.com, and I think when they update their forecast, we'll see that number be a much different number than a negative 1.7. But what we can see is we're going to have moderate appreciation this year. Personally, I think it's going to be closer to 5%. But if you look at the blue bar, that averages everyone in, including the Realtor.com, and we're taking a 2% appreciation. Now, as a lot of these, for example, the NAR projection was in October when interest rates were at 8%. When the new projection comes out later this month, early next month, I'm sure that 0.7% is going to go up pretty dramatically. And just recently, Zillow went from thinking prices were going to go down 0.2% to up 3.5%. Fannie Mae and Freddie Mac also made adjustments up. So I think we're going to continue to see those price adjustments heading up, but they're not going to be anywhere near double digits. We're going to go back to almost like the 50-year average of about 5% as a nation. All right, that's today's deep dive. I hope I helped you with that. I hope you can better explain what's going to take place with mortgage rates. That's crucial for you right now. It's good. Again, in order to be seen as a great agent in this market, you don't have to know what's happening. You don't have to understand what's happening. You need to be able to sit down with a buyer or seller and explain it to them. And that's what the deep dives are all about. Next deep dive, are boomers going to move? And if so, when? They're locking up a lot of inventory. There are a lot of couples on in their years, and I'm making fun of them. I'm one of my years. They have a 4-bedroom colonial, and all the kids are left, and their kids have kids of their own with houses of them. They're going to move. They don't want to go up and down the stairs. They don't want to pay the heating bill. They don't want to pay the air conditioning bill. They don't want to mow the lawn. But when are they going to move, and why are they going to move? We're going to cover that next Monday in order to help you prospect that group and help you understand exactly what they're thinking. As always, I want to let you know, if you're not doing video right now, ladies and gentlemen, you're making a big mistake. This is it. We have at KCM, we have a social media specialist. Her name is Molly. She's absolutely sensational, absolutely sensational. And all she wants to do, because she knows her job, she knows what's important. All she wants to do is take a video of everything because she knows that's what pulls. So every single time we do a deep dive, we align with it, one of our real talks, where we give you the script. We give you the ability to make a video very, very simply. We give you the script. We give you the visuals that you can use. And this script this week is, as mortgage rates fall, new listings trend up. It'd be quick, a minute video. Now, I know some people out there, well, I don't know about video. You're making a mistake. You need to do videos. Crucially important to any marketing plan you're putting together this year. Well, I don't really like the way I look on, on camera. You think I like the way I look on camera? Does that stop me from being here with you? No. In a few minutes in, you don't care what I look like. You care what I'm saying. In a few seconds in on your real talk, they're not going to care what you look like. They came for the information. So all those people that are really, really, really beautiful, it's not going to help you all that much. And all the people that aren't really, really beautiful, it's not going to hurt you at all. Just give good information. Your brand shouldn't be, I'm the best looking realtor in the marketplace. Your brand should be, I'm the best informed realtor in the marketplace. And one last piece to that, please don't forget. All right, you can go to you can go to trykcm.com/webinar, save your spot for this Wednesday's webinar. Crucially important. We're going to cover everything you need to know going forward in the forecasting of prices, mortgage rates. We'll go over that again, and we'll go over transactions. How many sales do we think is going to happen this year? Are we going to return? Are we going to do another 4 million, or are we going to return back to that 5 million plus? We'll give you everything that you need to know to move forward into 2024. Not as an agent, not as a good agent, but as a great agent. Thank you for your time this morning. As we always say, you gave me a half hour of your life. I hope I gave you a good return on that investment.